management. It is an attempt by management to influence or manipulate reported earnings by using specific accounting methods or changing methods, deferring or accelerating expense or revenue transactions, recognizing one-time non-recurring item, and using other methods designed to influence short-term earnings. Earning management reaches the specific and general duties of managers to shareholders. It conceals or alters information that investors, creditors, and other stakeholders should know about an organization. It creates the appearance of high corporate earnings to increase compensation for managers and to reduce shareholders' criticism. List of international companies with past earning management scandals. Enron Corporation was a U.S. energy, commodities, and services company based out on Houston, Texas. The company had been using accounting loopholes to hide billions of dollars of bad debt while simultaneously inflating the company's earnings. The scandal resulted in shareholders losing over $74 billion as Enron's share price collapsed from around $90 to under $1 within a year. The company CEO Jeff Skilling and former CEO Ken Lay had kept billions of dollars of debt off the company's balance sheet, and they had pressured the company's auditing firm Arthur Andersen to ignore the issue. Two were convicted by the testimony of Sharon Watkins. Lay died before serving time in prison, while Skilling was sentenced to 24 years in prison. The scandal has led to the bankruptcy of Enron and the dissolution of Arthur Andersen. The prosecutor and reversement indicted not just individuals but the entire accounting firm of Arthur Andersen, effectively putting the companies out of business. 20,000 employees had lost their jobs when the conviction was later overturned. WorldCom was an American telecommunication company based out of Ashburn, Virginia. The company had inflated its assets by almost $11 billion. They underreported line costs by capitalizing instead of expensing them, and had inflated its revenue by making false entries. The scandal first came to light when the company's internal audit department found almost $3.8 billion in fraudulent accounts. The company CEO, Bernie Evers, was sentenced to 25 years in prison for fraud, conspiracy, and filing false documents. The scandal resulted in over 30,000 job losses and over $180 billion in losses by investors. Tyco International was an American blue-chip security systems company based out of Princeton, New Jersey. Company CEO Dennis Kozlowski and CFO Mark Schwartz had stolen over $150 million from the company and had inflated the company's earnings by over $500 million in their report and siphoned off money using unapproved loans and stock sales. Both of them were sentenced 8 to 25 years in prison and paid $2.92 billion to investors. HealthSoft Corporation is a top U.S. publicly traded healthcare company based out of Birmingham, Alabama. It was discovered that the company had inflated earnings by over $1.8 million. The company CEO Richard Skrashy had been investigated after he sold $75 million in stock a day before the company posted a huge loss. Although charged, Skrashy was acquitted of all 36 counts of accounting fraud. However, he was found guilty of bribing Alabama Governor Dan Gilman and was sentenced to 7 years in prison. Freddie Mac is a U.S. federally backed mortgage financing giant based out of Fairfax County, Virginia. Mac had invested over $5 billion in earnings. The CEO, David Glenn, CEO, Lillian Bransell, CFO, Von Clark, and former senior vice presidents, Rob Dean and Nazir Bazan, had intentionally overstated earnings in the company's book. Glenn, Clark, and Bransell were all fired, and the company was fined $125 million.